the markets have come a long way on a lot of very high hopes, which I do think are going to end up being validated. But it's, you know, when you start to put paper to, or pencil to paper on a lot of this tax, a lot of these things that are going to be rolled out by the new administration, it isn't going to be necessarily as easy to get everything done or as quickly as everybody thinks. So I think to some extent this is somewhat of a pause as we start to really think about the details. Even for, you mentioned the border adjustment tax. I mean, this is a new element to this whole idea of corporate tax cuts and corporate tax reform that sort of complicates things, and people don't necessarily understand it, and what does it mean, and how do people feel. So I guess that's all I'm saying is, to some extent, the market is going to, I think, have a period where now it really tries to assess the details of what we're going to get, and so it's natural to see maybe a bit of a pause.
If you look at a snapshot of the current employment picture, and so that doesn't include any of these initiatives coming after January 20th. So what did things start to taper off in the last month or last 3 months versus the pace where they were? And is it because the supply is harder to find the right workers?
Well, there are a couple of different things. I was worried that the economy was cooling a bit in the second half of 2016. But certainly in the wake of the election, it looks like, with the help, I think, of the election outcome, which really seems to have gone a long way with consumer confidence, business confidence. I mean, it looks like the economy ended the year on a very, healthy note. I mean, even manufacturing, which is one sector that you would expect to see, because of the dollar, some headwinds. I mean, we had data this week that suggested activity was holding up nicely. Orders have been up. So I think the economy ended on a strong note. Now, with respect to the labor market, I think you're absolutely right. You know, we've seen some slowing. You know, we're looking at job growth trending below 200,000, which is slower than we had been maybe earlier in the year. But I do think some of that is a supply issue, as the labor market is getting, we've heard this from companies for quite a while now, actually, that it's hard to find workers, and that it's to some extent the cooling going forward that we may see, maybe more supply than demand related.
No, then that wouldn't really indicate, I mean, then you get some wage gains. That's the
validation for it. If that story is right, that it's more supply than demand, you need to see the upward pressure on wages. And we've actually started to see that. We're looking, even today, we'll go back to perhaps 2.8 year over year. Again, these are low by historical standards. But remember when we couldn't get above, 2.5%. I mean, we've seen a modest upcreep in wage growth. So there may be some validation.
Who do you listen to, Russ, over at your shop? Does Michelle agree with what you're hearing over at your shop? You got a lot of guys over there. We got more people coming from BlackRock all the time. I don't know who's in it. I don't know who. You got it all covered. You got long, short, up, down, higher rates, lower rates. Is she right?
I think she is right, Joe. I actually think that you nailed it earlier on. I think
no way.
Part of it, no, I hate to say it, but I think you did.
Is it my birthday?
Happy birthday.
Thank you. Tell me what it was. This is rare. How did I do?
You nailed it with your comment on the dollar, because the dollar is self-limiting. If the dollar rips, this is a de facto monetary tightening. And this is part of, I think, what's happening, where the dollar is doing some of the work for the Fed. And it's certainly going to be a headwind as we get into Q1 on profits. That said, going back to 235 on the 10-year, after coming off of 150 as recently as July, well, that's not really a big reversal, and I think you do get to 3%. But again, Joe, as you said before, it's not a straight line. It's probably a good thing that it's not a straight line.
Yeah. So what does all that mean about equities? Because that's your thing, isn't it?
Well, we're multi-asset class, but I think what it means for equities is you have an environment where rates are backing up because the economy is getting stronger, because there's some reasonable prospect for fiscal stimulus, for lower taxes. That's okay. Again, multiples actually can go up if rates are coming up from a low level. The key is, are we getting real growth, and is that going to support earnings in 2017? Because we've gotten to a point in the equity cycle where you can no longer depend on multiple expansion to drive the next 10 or 15%.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.